Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. Today we're taking a closer look at the IPO market. EquityZen is here to dissect the evolving climate for new issues amid an eruption of headlines surrounding WeWork, as well as Peloton's recent public debut. And we're analyzing the chart action for Beyond Meat to show exactly why timing is everything when it comes to buying IPO stocks. Plus, an AI and FinTech consultant and investor will share insights about the venture capital market and the impact of trade tensions with China on foreign investments in U.S. startups. Investing Strategies starts now. Okay, let's kick things off with our market insights this week. An unresolved trade war with China remains one of the biggest threats to the stock market rally, with all eyes looking ahead to high-level talks resuming on October 10th. But beyond trade, investors have been swift to react to any White House-related headlines, positive or negative. Now, the NASDAQ is below its 50-day moving average and the 8,000 level, both key areas for technicians. Investors should be aware that even if the rally holds up or gains ground, abrupt shifts in the market are likely to occur as headlines and tweets shift sentiment. Now, the bottom line here, let the market tell you where it's headed rather than trying to predict where the market will go. All right, with that, let's now turn our focus to this week's spotlight on the IPO market. With me for today's discussion is Adam Agushak-Burrow. He's a senior research analyst at EquityZen. Now, thanks so much for joining me today, Adam.
Yeah, thank you for having me.
All right, so the IPO market really in the headlines right now over the last several weeks between all of the headlines with WeWork, at the very least delaying its IPO, Peloton going public last week. What do you think all of these headlines say about where we are this year with IPOs when it's been such a big year for a lot of big debuts, but you know, it hasn't all been super stellar what we've seen so far?
Yeah, definitely not the rosiest picture across the board. In terms of key themes, I would say primarily this has been a year where those sort of decade plus, Silicon Valley backed unicorns finally really just started to open up the gates and going public, So, we saw Uber, we saw Lyft, we saw Slack, a few others, and those were obviously highly anticipated IPOs, and this is, I think, the first year where we really started seeing a lot of these kind of, decacorns going public, and not as many left, as we look forward into the next year. Another key theme, I think, is what you alluded to, is exactly, that there's been uneven performance throughout the IPO market. I would say, what you would historically consider to be software, enterprise software, SaaS, those businesses are, I would say, still performing quite well in the IPO markets. You've seen some, sideways trading or trading down from companies like Slack, but you have Cloudflare, you have Zoom Video Communications doing really well, Datadog, all of those companies still trading, above their IPO prices. Obviously Uber, Lyft have been trading a bit differently, but they're very different businesses. I think they've been characterized as tech companies, and to a certain extent they are, and they leverage technology, but they do not have the kind of software margins you'll see, 80% gross margins. They're more at the 40% gross margin level. So they're very different businesses, and I think public markets investors are reacting differently as a result.
Right. So what do you think the implications are then if there are, two totally different tracks, I guess you could say, for valuations in the private market, and then when it comes to the public market, that being seen a little differently? Yeah,
sure. So I would say, first of all, I think the trend in the private markets the last several years has been to ascribe, higher, software-like multiples to businesses that are not necessarily really software companies. There's the famous phrase, software is eating the world. That's certainly true to some extent, or something that I agree with at least. But, I think technology has impacted certain businesses, consumer-facing businesses. I think the ones that really come to mind are, food delivery, ride hail, even now the kind of alternative meats craze and Beyond, of course, is doing very strongly after its debut. So, there's definitely been a trend of ascribing these much higher multiples, I think, to these direct to consumer or sort of services business that, I would characterize as more tech enabled and not purely, tech companies or software companies. I think what we're seeing now is, while that was a trend in the private markets, in the public markets, that's not necessarily something that the public investors are necessarily buying. You've seen, particularly in ride sharing, the kind of IPO multiples were more towards the double digits, which you would expect from, kind of a fast growing tech company. Now they've pulled back to, 4, 5, 6 times revenue, kind of depending on, where you're looking at the last few months. So, the divide between the public and private markets is definitely there. And, I think those differences in what investors look for are definitely, being shown now with how some of these companies are performing.
Right, and as you mentioned, with a lot of these companies waiting longer and longer to go public, that means that the environment in the private market has shifted too, and maybe investors wanting to go there now with what they're seeing, if they're seeing an IPO, maybe it's just a short term. We don't know long term, of course, with a lot of these, but maybe they might feel like they see more success there. What is equity doing in that space to appeal on and give access to investors on the private side?
Sure, yeah. My company operates a pre-IPO marketplace for, buying and selling these sort of large, proven, venture-backed company stocks. And we have seen very strong demand. We've seen, consistent demand and growth in demand year over year, because you're exactly right. Now the average tech company from sort of first fundraising to IPO is, over a decade old. We're sort of like approaching teenager status for a lot of these companies, whereas, 20, 25 years ago, that time period between, first founding or first fundraising to IPO was maybe 3 or 4 years. So the capital markets are definitely very different. There is so much more value creation now in the private markets, whereas I think before we were very used to seeing, a 3 or 4 year old business IPO with $20 million of revenue. Now we're seeing a 10 or 11 year old company. Lyft had over $2 billion of revenue. Uber had over $11 billion of revenue. These are very, very different businesses today. So it makes sense to me and to us why there's so much more interest in the private markets. And that is exactly what we've been trying to build, is this marketplace that has been democratizing access to this, pre-IPO asset class. And you no longer have to write a $10 million check as a VC to do it. We are opening access now to accredited investors who are able to, take advantage of this.
All right, well, let's talk more about the public side now. With Peloton going public, we're going to incorporate that into our conversation of this week's Stocks to Watch. So it just went public. It's still early, but what do you make so far of the stock's debut, and then putting that in the context of the story and the business model? You mentioned this is one of those more tech-enabled companies.
Yeah, definitely. I think there are a few themes that we can address here. It's primarily a hardware business. They had a bit over $900 million of revenue last year. I want to say about 20% of that was this kind of recurring subscription that you can pay for to get access to all their content. But still, the lion's share of the revenue is coming from their hardware production of their treadmills and their bikes, which have become very, very popular. The company grew over 100% last year. But they're very two businesses, and between the kind of recurring revenue subscription business and the hardware business. And we've seen hardware historically struggle both in the public and private markets. You have businesses sort of like GoPro or Fitbit, which trade at much, much lower multiples, probably below 1 times revenue, while you have SaaS businesses that trade in the double digits. So I think investors are sort of figuring out still exactly what kind of business Peloton is going to be. They clearly were able to convince many sophisticated institutional investors that the subscription side of the business, the recurring revenue side of the business, is going to continue to grow and become a larger percentage of overall revenue. And that's been the case. The subscription business has been growing faster than sort of the sales of the treadmills and the bikes. But I think investors are going to want to see more of that and get comfortable with that, so that Peloton's multiple stays relatively relatively constant. And if they're going to be growing the subscription business, then we might actually see some multiple expansion in the future. But right now, I think it's too early to tell. We'll see how things go in the next few earnings releases.
That's right. We'll definitely be keeping an eye on that. And then quickly before we go, I also want to touch on Zoom, because this is one of those more software-focused companies that we did see go public this year. So what are your thoughts on that when you compare it to more of like a Peloton that's a hardware company?
Yeah, I think investors can understand it a lot more easily. It's a business with 75% plus gross margins. That translates to a very different operating margin picture. Your ceiling on profits, is your gross margin. If you lose 50% of your revenue for the cost of producing your good or your service, you're obviously starting yourself at a much lower level. So I think that folks understand that the high gross margins translate to a much clearer path to profitability, and businesses then can take advantage sort of at the operating expense level of more initiatives to boost operating leverage. They can cut sales and marketing, things like that. But your cost of goods, what it costs to create your software, your product, or your good, that's a lot harder to change. And that's why, I think a company like Zoom or other software or SaaS businesses, have been performing relatively robustly compared to other types of businesses with just very different margin profiles.
Yeah, that's right. And obviously with the profitability here, that's a good sign. But even with the brighter fundamental picture here with Zoom and other software companies, seeing broadly, I think a lot of these IPOs pulling back, even Beyond Meat after a huge run, that has come well off its highs. Do you think that kind of action broadly in the IPO market puts a bit of a damper when it comes to other unicorns looking to go public?
Yeah, I think so. I to a certain extent, I think if you're a smaller business, you might be a little bit more hesitant now. There also are, of course, sort of these macro trends, geopolitical risks, political risks that investors are, pricing in, that issuers are pricing into their decisions. But I think if you are a large company, you are cash flow positive, and you have a strategic need or desire for an IPO, I don't think the sort of general pullback in some of these businesses that have been a little bit weaker post-IPO is going to matter too much. The one company that comes to mind really is Airbnb. It's a $30 billion plus company. Also, I think founded in 2009. We're over a decade old at this point, but we know it's a EBITDA positive business. It's a highly scalable business. There are certainly strong network effects associated with building out the Airbnb platform globally, and sort of no matter where you're traveling to, it's probably the first resource you're going to consult, other than maybe a hotel or something like that. So, that is an example of a company that I think is going to, pursue its public debut. In these conditions, it's possible something massive derails them. But right now, that's a business that I would feel very confident in IPOing, in the next 6 to 12 months.
All right. Well, we definitely know there's a lot of heightened scrutiny, and investors are looking very closely at these business models.
Yep.
That's definitely for sure. But Airbnb on the radar for sure is one of the next big debuts to come.
Definitely.
So we'll keep an eye on it. Thank you so much for your insights.
Thank you. Appreciate it.
All right. And after the break, we're going to take a look at the chart action for recent new issue Beyond Meat and a lesson about timing when it comes to buying IPO stocks. We'll be back in a minute.
Leaderboard helps you invest better with winning stocks picked by our team of experts. Select a stock to see current analysis. Check the chart for buy and sell points, plus get real-time price alerts. Improve your investing with Leaderboard. Start your free trial today.
If you're trying to find stocks that are in their early stages of growth, IPOs are of course a great place to start. With Peloton, Lyft, Uber, Beyond Meat, and many other high-profile IPOs hitting the market this year, there's heightened investor interest in new issues. But amid all the chatter and hype that can come with these high-profile IPOs, it's important to know how to properly handle IPO trades. Investors should be aware that there's added uncertainty that comes with buying IPOs on their first day of trade. That's because IPO stocks tend to be on the volatile side and risky since they don't have a trading track record. To put it bluntly, with IPOs, it can either be feast or famine. From Facebook's debut in 2012 to Snap's in 2017, there are many examples of IPO trades that quickly head south right after the first day. With Facebook's IPO, it took that stock more than a year to get back to the level it was trading at when it first went public. So instead of holding and hoping for an eventual gain, which you could potentially get as a long-term shareholder, investors who are wanting to be more tactical should instead approach their IPO trades by looking for what we call an IPO base. We've found that many top stocks start their first major moves after forming these IPO bases. Now, because not all IPO stocks explode higher right out of the gate, that's exactly why IBD looks at IPO bases to have an edge with our IPO trades. Our research shows that waiting for an IPO stock to break out of an IPO base before buying increases the likelihood of a winning trade. So let's talk about what we mean when we say IPO base, and let's shift our attention to the chart of Beyond Meat to explain. Now, Beyond Meat is a great example of a big IPO winner this year. Now, essentially, an IPO base forms when a new issue consolidates its gains shortly after going public. And these patterns can form in as little as 5 days of trade, which is much shorter than the standard base patterns that IBD looks at, which need at least 5 to 7 weeks to form. Now, after just 4 days of trade, Beyond Meat started to consolidate, forming this IPO base here with a buy point at 85.55. And the stock broke out above that level, clearing prior resistance. And after shaking out some shareholders, Beyond Meat continued to blast higher. And it offered investors multiple buying opportunities here, with another base here, and then we also had a cup with a handle pattern forming here. And now the plant-based meat stock ultimately ran up as much as 858% in less than 3 months. A massive jaw-dropping run here. And it all started with this IPO base. You can see how the stock took a quick breather to digest its gains to form the IPO base. And when shares cleared that prior high and hit new high ground, Beyond Meat was able to prove its strength. When you see action like this, you are putting the odds of success in your favor. And fast forward to today, Beyond Meat is now trading around the 150 price level. Being tactical when you buy also requires being tactical when you sell. And with the last breakout and move here from Beyond Meat, IBD would have sold once the stock fell 7 to 8% below the entry point, and then once it broke below the 50-day moving average in above average volume here. Now, Beyond Meat could be forming a new base now, so we'll just have to wait and see when and where on the chart the next buying opportunity might be. And while the chart action is clearly crucial here, the fundamentals matter as well. Beyond Meat has reported sales growth of well over 200% in its first 2 quarters as a public company, and it's expected to turn a profit sometime in 2020. IBD's research shows that the best IPO stocks have sales growth of at least 30% and sometimes much, much more. And since many new issues are not profitable, seeing the path to profitability with Beyond Meat is positive. So remember, with IPOs, buying on the first day of trade is risky. If you wait to buy after an IPO base forms, you're putting the odds of success in your favor. And for even less risk, investors interested in gaining exposure to new issues can also consider ETFs. Renaissance Capital's IPO ETF and First Trust's FPX ETF are 2 examples of funds that focus on recent IPOs. All right, so when we come back, we'll be discussing the venture capital market and the impact of trade tensions with China on foreign investments in U.S. startups. That's happening after the break.
This season on Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3 AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
So earlier we talked about the IPO market and the changing climate for new issues. And now we're going to touch on the venture capital side a little more, as well as discuss the relationship between the US and China when it comes to technology transfer. Someone with firsthand experience in both of those areas and more is Carson Kahn, an AI and FinTech consultant and investor who is named a top 100 entrepreneur by Goldman Sachs. Thanks so much for being here today, Carson.
Thank you, Ali.
All right, so you're very involved in the venture capital markets. Tell us a little bit about what you're seeing right now with that, and putting it, I guess, in the broader picture of this landscape of what we're seeing with all of these IPOs coming out. Clearly, you know, we're taking a look at the very beginning stages of that with venture capital.
Yes. So I think venture capital right now is definitely choppy seas, but it's a little bit unclear whether it's the boat we're riding on, the windshield, or the seas themselves that seem to be broken, because some of these IPOs are doing just fine. Zoom and Cloudflare, the companies with good margins, seem to be performing pretty well in the markets. Where we see a lot more struggles in companies that haven't been able to quite realize that software or so-called tech multiple, or have operational challenges, some mismanagement challenges. So I think VCs are about to start demanding better corporate governance, among other things. WeWork withdrawing their IPO earlier today is a sign of that.
All right, and you're specifically looking at AI and cybersecurity and FinTech. What are we seeing in terms of new developments in that space?
So alternative data is becoming a major focus. That's looking at sources of data that maybe historically haven't been leveraged for training machine learning models in the past. And a number of companies are partnering exclusively with large customers or small customers who haven't been able to deploy machine learning in the past but have valuable data sets. That's going to be a major crop of companies coming up through the venture ecosystem over the next several years. I also think they're shifting focus to types of data that haven't been exploited so structurally in the past. A great example is natural language data. Of course, we're all very familiar with sentiment analysis and everything else, but it's starting to become the case that companies can really synthesize natural language from scratch, that companies can automatically write encyclopedia entries, that companies can analyze collections of emails to determine who knows what about an issue. And while some of those technologies certainly have potential for bad actors to exploit them, major companies also have needs in knowledge management, in training, in market analysis that can leverage those technologies too.
All right, very interesting. And we hear a lot, I think, about the AI race between the U.S. and China, and with all of the trade war tensions and even recent headlines about rumors out there of potentially Chinese companies being delisted on U.S. exchanges, that, just heightened tensions, bottom line. What do you make of that race for AI between these two giants, and how we can work together, or what are the challenges in that?
So I don't think that in the public view AI has entered the trade spat very much. I think there are two separate issues. The first being the way that economic warfare has become information warfare, and vice versa. So you have rumors coming out of the White House that maybe the US will prevent Chinese access to US capital, affecting companies like Alibaba or JD.com or New Oriental, only to have Peter Navarro at the White House come and say, no, fake news. If you watch the indices seesaw over that sort of saga, it's just information moving those needles. And so I think talk has as much impact as action these days. There's not a lot of talk about the AI side. Where we really see that battle playing out between the US and China right now is more in the private market. So some of the world's biggest and most influential AI companies, many American investors haven't even heard of. SenseTime, which was incubated by the Hong Kong Science and Technology Park, where I just visited, or ByteDance, which runs the popular social network TikTok, was recently revealed that their content moderation guidelines in the US may in fact be fora for Chinese propaganda. And those are some really difficult issues when you've got companies at the leading edge of machine learning, especially for natural language processing, computer vision, and other critical national security technologies, gaining commercial footholds in the US or with US businesses, but potentially have involvement from the Chinese state.
All right, tell us a little bit more about your recent trip to China and what you learned there in terms of, I guess, the appetite for investment there, even given these sort of undertones with the tension happening.
So the most interesting location was certainly Hong Kong, where venture capitalists were eager to play down the degree to which that unrest might be affecting their local startup ecosystem. I think that it's still the case real estate remains the most attractive in the Greater Bay Area, Hong Kong, Shenzhen, Macau, as well as in other major metropolitan areas of China. But venture capital is strong and getting stronger in Greater China. I think that the involvement of government and university technology transfer plays in the venture capital ecosystem gives that community access to technology that here might take longer to commercialize, and that's one potential advantage that they have. But of course, at the same time, the US has been tremendously strong in the last 20 years in taking small garage startups and building them into multi-billion-dollar companies. Even with the extended time staying private, we're still seeing many more US software companies IPO than we're likely to see Chinese software companies IPO over the next couple of years.
All right, so do you think that there is a little bit of added risk in striking a deal with China players, or how do you think that's all going to shake out?
I think it's anyone's guess at this point and will be heavily influenced by coverage of the US elections as much as anything. I do think that there are some ongoing national and economic security issues that will be affected by those talks, though, and those could influence the way startups raise capital and operate in the US. Probably the most well-known example of this is CFIUS, the Committee on Foreign Investment in the US, which in some cases, and I've seen this happen, can block Chinese limited partners or companies from making investments in private US technology companies. And as the trade war plays out, we're likely to see some of those screws tighten up, potentially even against Saudi money and other nationalities whose capital is maybe not as welcome in the US at this particular stage. Likewise, though, this can be to the detriment of US startups who are seeking to do business in China and might face political or even just optical hurdles as they seek to broaden their market access.
Right, but your view then is, looking long term, is it a positive view on the prospect of a trade deal happening and then that kind of unlocking more dollars on the venture capital side between the two nations?
I think venture capital has been negatively influenced by Chinese money over the last 5 to 10 years because it contributed to today's frothy venture capital environment, if you will, where capital is so easily accessed that many companies that maybe aren't ready for that capital infusion were able to access it a few years back. That has since withdrawn, and although the venture capital market continues to balloon into what some would call a bubble, the quality of companies raising capital from domestic LPs has still, I think, gone up slightly since that time. If we saw Chinese capital revert to the US market in the event of, say, a successful trade deal and the political appetite for that, I think in the venture capital and technology community, we'd want to see improved standards of diligence, which the industry needs broadly anyways, as well as, of course, sensitivity to those national security concerns that oftentimes are at the intersection of software and foreign investment.
All right, well, you raised some very key points, and it was really great to get your perspective today on these very interesting topics that I know we'll continue to see a lot of developments in the coming weeks and months. So thank you so much for your insights.
Thank you, Ali.
And thank you all for watching Investing Strategies. We'll see you right back here for our show next Monday, featuring William O'Neill Chief Investment Strategist Randy Watts, Innovator Funds President Bruce Bond, and MongoDB COO and CFO Michael Gordon. Until next time, I'm Alissa Coram.